Okay, hi everybody. My name is Richard.lesperance. I go by the name of my man Richard. Welcome to our better lifestyle. Today I have the pleasure to have August Biniaz with me. August is doing some great works in the real estate industry, so we'll be talking about syndications, how to structure syndication business. Welcome August to the podcast.
Thanks for having me, Richard. Looking forward to this.
That's my pleasure. So we were talking before, so August knows in which direction I'm gonna go. So we were talking, you were in Canada before, but you got started in the syndication. If someone wants to get started in the syndication business, whether they are in Canada or in the US, how would they get started?
Well, I mean, there's a step before that, right? The step before that is why do you want to syndicate? And what is syndication? Syndication is basically a process, a mechanism to bring in investors and the sponsor, the general partner, to execute a deal, right? A business deal. It could be a real estate deal. It could be in other businesses, but whatever it is an ability to bring in investors and the basically the mastermind to be able to conduct a business. That's the syndication essentially, right? Now, if somebody wants to do a syndication, it really depends on the business plan. What is the business plan? In the real estate world, obviously at some point when you're doing deals, you run out of your own money, or even to start with, you don't have your own money. And the latter is probably not the best way to go about it, because if you want to go to the members of the public and raise capital from others, even if it's not members of the public, if it's your own family and friends, you want to have some track record. So if you have some track record in certain real estate, you most probably had made some profit. So you should kind of be investing your own funds in the deal as well. But yeah, I mean, so the business, what is the business model? Is the business model to do development deals in Canada? Is it to build apartments? Is it build single family? Is it to buy already existing apartments? Is it to do short-term rental? A lot of different business models that exist in real estate. A lot of different ways to make money. Syndication is just a vehicle that allows you to raise the equity needed from investors for your deal. There are also mechanisms within Canada or the US to be able to legally do so. In the US, the space is called the private placement world. It was called private placement. In Canada, it's called the exempt market. And you're able to go in, legally raise money from members of the public while advertising, the deal that you have. So. That's some basic foundational stuff, but I'm sure you're gonna have more questions.
Is it you said private placement? Is it the same as a PPM?
So PPM is a private placement memorandum, which is a document that your securities lawyers in the U.S. prepare for you to be able to raise capital under the Regulation D, either 506B or 506C. So that's the document that's used to provide to your investors as some form of a prospectus or a prospectus light. In Canada, we'll have a similar document as well, which is your subscription agreement or limited partnership agreement, which is given to the investors. So yeah, the private placement, the title is just a space that sponsors, general partners, individuals can they practice in. That space is called the private placement space. The documentation that you utilize to give to your investors to review and sign to be able to invest in your deals, that documentation, as long as you're using the Regulation D, that documentation is called your PPM, private placement memorandum.
Uh, is it the document they have here in Canada? Because I was doing some research. Is it the instrument 45 and 106?
Instrument 45106 is a national instrument that allows individuals and companies to go out there and raise capital. Now, the way, kind of to give you a quick crash course on capital raising, both in Canada and the US, but putting a focus on Canada initially, is that if you have a business idea or a venture and you want to go raise money for it from members of the public or others, the regulators force you to go through the IPO route, initial public offering, go through this the Wall Street, the stock market route, and raise capital through an IPO. That's how large companies raise capital. But a lot of smaller firms, a lot of people in real estate, they don't want to go through the IPO route because it's very costly. It costs between $500,000 and $1 million. It takes usually a year for an IPO to go public. So an investor like us, Richard and August, they want to go and buy a multifamily building in Ontario. They're like, hey, regulators, we don't want to go through spending $500,000 to $1 million. We don't want to wait 12 months to go through this. We want to raise money today. We have 60 days to close. So the regulators turn around and tell us, all right, if you want to raise money and you don't want to go through the prospectus route, you don't want to go through the IPO route, I'll allow you to use some exemptions from going the IPO route, from going the prospectus route. And here are the list of exemptions you can use. So the list of exemptions are private issuer exemption, offering memorandum exemption, accredited investor exemption, friends and family exemption, crowdfunding exemption. So there's a list of exemptions you can use in each province you raise capital from. In Canada, securities commissions are provincial. In the US is just federal, just the SEC. So you have to adhere by those regulations. So let's say we have a project, we want to buy an apartment building in Ontario. Most of our investors are from Ontario. So we have to adhere to Ontario's securities regulation to be able to then use one of those exemptions that exist, or we can stack them as well. But we have to comply by those rules and regulations to be able to raise money from investors. So essentially the investors and ourselves, we're relying on an exemption from going the IPO route, raising the money. Our legal team will then draft the documentation similar to a private placement memorandum with the Canadian version, and our investors then use those, they will sign those documents and they will receive either shares, or if it's a limited partnership, in most cases, they'll receive the units for the limited partnership to be able to be a part owner, a passive investor in our deals.
Speaking of your team, you mentioned before, who needs to be in your team? Because I believe you need a securities lawyer too, cross-border lawyer, so all these people. So who do you need to have in your team, the main people?
Again, goes back on your business model. Again, now you have your internal team, you have your external service providers. So if you're looking to syndicate deals, I'll say for like I'll do three different kind of versions. I'll do for Canadian deals, US deals, and cross-border deals. So if you're doing a Canadian deal and you're looking to raise capital from anyone, it doesn't matter if it's members of the public, doesn't matter if you're advertising, doesn't matter if you're raising just from family and friends, you should definitely have a securities lawyer. Usually securities lawyers are also corporate lawyers, so they act as your securities/corporate lawyer. They will incorporate all your entities. If you're utilizing the limited partnership or a corporation or both, they will draft all your legal documents, your subscription agreement, limited partnership agreements, and so on. And they will make sure that you're being compliant on the security side of things, making sure that you're not triggering any issues regarding compliance. So that's your securities attorney / corporate attorney. Then you have your accountant. Now, for doing Canadian deals, you probably want an accountant who understands these types of deals, these deals that involve investors and so on, so they can prepare the annual filings for these deals and they can provide you advice. So you need your Canadian CPA who's very familiar with the syndication and the private equity world, the funds and syndication world. And then in some cases, if you're looking to continuously repeat and do more deals, you also need the services of a exempt market dealer. Exempt market dealer is a third-party service provider that allows you to be able to sell the securities, and they conduct a KYC, know your client, KYP, know your product, on behalf of the investors, making sure that they're making the right investment and they're complying with the securities regulation, and that you're not triggering any being in the business of trading securities. So they will come in at some point, but it's always good to at least book a call with an exempt market dealer to understand how that side of things work when it comes to regulation. Aside from that, I mean, depending on your business model, there's other service providers outside of the structure of the deal. You need your the brokers. Brokers are extremely important in deals. They're out there sourcing all the deals. You need your property manager. You need your bookkeeper. If you're looking to build an actual firm, you probably need a marketing team, either local or overseas. So yeah, maybe you probably have more questions.
Mhm. Uh, what's the difference between real estate syndication and a real estate fund?
Oh yeah, great question. So so a lot of time the verbiage, it gets fashionable in the real estate world, and people just throw around words, right? Terms. So when you're talking about a fund is just any entity that holds money in it, and that money is used for a certain mandate, a certain venture, right? That's a fund. So if you create a bank account to go and buy, equities online, that is a fund in itself, right? So it's important to distinguish. But when it comes to real estate, and you're distinguishing between syndications and funds, even though a syndication is technically a project-specific fund as well, because it's an entity, it has its own bank account, it's raising money, it's got a vision and mandate. So essentially, it's a fund as well. But let's distinguish it, because in the real estate lexicon, sometimes these terms get thrown around. So a syndication is, in most cases, a project-specific deal. So it's one deal. The investors who invest in a syndication have exposure only to that one deal. The sponsor, the general partner, goes out, sources a deal, does the analysis, the deal makes sense, then goes to his attorneys, packages it up, and provides that deal to investors to have exposure on. So that's essentially a syndication. A syndication is also different than a joint venture. If Richard and August want to do a deal, we create a corporation and we go buy an apartment building in Canada. That's more of a joint venture because it's just two of us, or maybe three or four of us. That's more of a joint venture because we all are signing on the loan. We're all our active partners. So that you call that more of a joint venture. A syndication is when we're actually going out to members of the public, our family and friends, or advertising through online means, and bringing people to invest as 100% passive investors. So all they're doing, they're allocating capital, while we, as or either myself individually or me and you, are the general partners, and we manage the deal and we're the sponsors of the deal. So that's a syndication. A fund is a bit more broad. A fund is a vehicle which allows August and Richard as general partners to raise capital and buy multiple deals. So it's a basket of deals. So instead of just buying an apartment building in Ontario, we raise a bunch of money from investors and we go and buy 5 or 6 apartment communities, apartment buildings in Ontario. That's usually a fund. Funds also have, depending on what type of fund they have a lifespan. So you can have a closed-end fund. Usually closed-end funds is a 10-year fund. The first 1 or 2 years is, the GP goes out there and raises the capital needed for the fund. The next 5 or 6 years, the business plan is executed, the assets are purchased, and so on. And the last couple of years, the deals are divested, and the fund is wrapped up, and all the profits and initial investment is returned back to the investors. That's a closed-end fund. You could also have an open-end fund, evergreen fund, where it continuously raises capital, it continuously acquires deals, it continuously executes a business plan, and then it also continuously divests deals and returns those economics back to the investors. So you could have both of those vehicles. Now, both of these types of business models or entities, a syndication, a joint venture that we discussed, if it's just 2 or 3 or a handful of people that they're all active investors, a syndication where it's an active partners like Richard and August, and a group of investors that we raise money from, either people we know or we don't know, or a fund where we have this ongoing business model that we keep buying deals and keep raising capital. All 3 of those ventures can still be structured in the same vehicle, a limited partnership. So sometimes people get confused. Hey, is there a different vehicle used for a fund and a syndication and a joint venture? No, the same vehicle, the same entity that your lawyers incorporate for you, it can be the same entity. It can be a limited partnership. And in most cases it is. That's the best entity to use because it distinguishes duties and responsibilities and allocations and contributions between the different type of partners. The limited partners who have limited liability, their liability in most cases is just the capital they have invested in the deal. And then the general partner that has unlimited liability. So if there's a lawsuit, if there's issues with a loan or what have you, it all falls back on the general partner.
In regards to the tax advantages in the US, I know it's very favorable in regards to tax advantages. What about like, because we were talking before, let's say I'm here in Canada and doing a deal. I have a deal in Canada, but I'm working with US investors. How is it different in regards to the tax advantage if an investor from the US would invest here in Canada?
Yeah, so let's first look at what are some tax advantages that the US has over Canada. What are some tax advantages that Canada has over the US? And these are the ones that I'm familiar with. So there might be there's possibly some other tax advantages that I'm not familiar with. So the main one that is utilized by a lot of real estate investors and is very common is the 1031 exchange, is the ability to be able to defer your gains and the taxes you have to pay in a property that you've sold indefinitely in most cases. So you buy a property for $1 million, you hold the property for a few years, and now the property has gone in value, and you end up selling that property for $2 million. You have $1 million in profit. At the 1031 exchange, as long as the deal is structured in the right vehicle, it's remember we talked about those vehicles, limited partnerships, corporations. In the US, you have LLCs. In Canada, we have no LLCs. As long as the deal is structured correctly, you can defer those taxes on that $1 million as long as you reinvest those profits into a new deal within a limited time period that you have, usually 3 months, that you have to be able to reinvest those funds into a new deal. As long as you do that, you can defer the taxes, and people continuously do this. And in some cases, if their will is structured correctly, even their heirs don't have to pay taxes, and that's going to be basically written off. So that's a very common one, 1031 exchange. So we don't have anything similar to the 1031 exchange in Canada. The other very common, particularly for buying apartments and buying real estate, a tax advantage that the U.S. has is depreciation. So in the U.S., you buy, and this depreciation also flows through to the passive investors, to the limited partners as well. It's not just for the general partners or the managers. If you have investors in your deal, you can actually utilize some of that depreciation to flow through to your investors. So the way that depreciation works is that you buy an apartment building for $1 million. That building has certain aspects of the structure, not the land, but the structure that depreciate. So you can use a cost segregation expert, do a study, and that study tells you how the material used in that structure depreciate. You can then front load that depreciation at the beginning of the first year that you buy the deal, and you can use that depreciation against your ordinary income. So let's say we bought a Richard in August. Let's say we're American, we're not Canadian, right? And we'll get into the complexity why that matters. But we're Americans. Our investors are all Americans. We buy $1 million apartment community in the U.S. We do the cost segregation study, and we realize there's $200,000 in depreciation that we can utilize against our ordinary income. So myself and yourself, we use 50,000 of that $150,000 depreciation, and if we flow through 150,000 to our investors who have invested with us in our deals, they can use that money against their ordinary income on a pro rata basis. So that will lower their taxes. Now there is a element of recapture when the property is sold, but again, if the sale is structured correctly as well, and we can reinvest the profits in a new deal, we can continuously defer taxes. So that's when it comes to 1031 exchange, and when it comes to depreciation. Now in Canada, there is also depreciation that can be utilized in real estate. However, a depreciation for the first year is only 2%. and depreciation for the second year and ongoing years is 4%. 4% a year you can utilize for depreciation. So there is a component of depreciation, but it cannot. It's not to the level of the U.S., whereas in some cases coming back now. Trump's administration has brought back the bonus depreciation through the big beautiful bill, so it's coming back from 50%, is making its way back up to 100% again, because the Biden administration start phasing out the bonus depreciation. Now it all sounds very rosy, but when you have Canadian investors investing in the U.S., it could create some complexity because Canada that doesn't recognize the same velocity on depreciation. So Canadian investors might not be able to utilize depreciation, but your US investors will be able to use depreciation. So now when it comes to US investors investing in Canadian deals, as far as tax advantage, I don't know of any, but I'm guessing they could possibly use up to 4% a year against their ordinary income, but that gets pretty complex. Now, last point of this, is there anything in Canada? A lot of people complain about Canada, particularly cross-border investors such as us and our firm CPI Capital. We always complain about Canada, but there is a tax gambit that exists in Canada. And I used to be a home builder for over a decade, and I realized a lot of my peers in the business were utilizing this gambit that exists in the tax world, and that's the primary resident capital gains tax gambit that exists in Canada. So if you bought a property for $30,000 30 years ago, 40 years ago, and now that property is worth $2 million, as long as that property is your primary resident, you pay $0 in capital gains. If you buy a piece of land and you build a home on it and you move into that home and your intent was to live in that home and you end up living in the home for a few years and you sell that home for great profit. Now the Canadian real estate market is not doing tremendously well now, but it had done great from 1995 to 2015. It had gone up 500%. So people made fortunes by building homes or buying a home, renovating it, increasing, creating value, and selling in a few years, and continuously doing that for a period of time and building that equity without paying a dollar in taxes. In the U.S., if a property is your primary resident and you've lived in it for, doesn't matter for how long, your capital gain exemption is capped. So it's capped, I believe, is at $300,000 as an individual, $500,000 with a spouse. But anything above that, you're paying capital gains on. Now, capital gains is lesser amount in the U.S. than it is in Canada, but that's one gambit that exists in Canada. That's one tax strategy that exists in Canada that doesn't exist in the U.S. So those are some on a high level.
There's some fees involved, like acquisition fees and other fees like that. Can you talk to us about that from the syndication?
Yeah, the fees you're discussing is the fees that the general partner, the skipper of the boat, the manager of the deal, charges the deal for their initial upfront work or continuous work they're putting into the deal. So the general partner of real estate private equity deals, they get compensated by two types of mechanism. One is through management fees, and the other is through performance fees. So the management fees, as you mentioned, are fees such as acquisition fee, which is around 2 to 4% of the purchase price, asset management fee, which is above and beyond the property management fee, which is something around 3% of the gross rents collected. There could be other fees such as loan guarantor fee. There could be an exit fee. There could be other fees. So depending on the general partnership that investors partner with, they could have multiple fees or just a couple of fees like the acquisition fee and asset management fee, which are very common. Now that's on the management fee front. On the performance fee front, is not really a fee because the management fees, the acquisition fee, asset management fee, loan guarantor fees are paid up front to the general partner, no matter of the performance of the deal. But the performance fees, which is also called the promote or the carried interest, is the general partner's portion of the upside. So Richard and August are the general partners of an apartment community they're buying in Ontario. They have 10 investors who've come in and funded the equity that's needed for that project. So we charge a fee. We buy the building for $1 million. We charge a 2% acquisition fee. So we get paid $20,000 up front, and we charge 3% of the rents on a monthly basis. So as all the rents we collect, we take 3% off the top. That's for our work we're putting in. But we also get a portion of the upside. So after 5 years, the building had gone up in value. We've forced appreciated through renovation. Now we're selling the building for $2 million. We've made $1 million of profit. There's a profit split mechanism where we take, in most cases, 30% of the profits of this project from the partnership. So we take 30% of the $1 million, which is $300,000. So the general partners, the sponsors, get compensated through fees and through the promote the carried interest. Fees are such as acquisition fee, asset management fee. The carried interest, the promote, the portion of the upside is usually between, I've seen it as low as 10% all the way up to 30, 40, 50% in some cases, depending on the performance of the deal. Now, you also have another very important mechanism that we should note. At times when this partnership is created between the general partner and the limited partner, in some cases it's just a straight split between the two. But in some cases there's also a waterfall, which is also hurdles that exist. So that's a mechanism which allows a level of security for the investors. The investors don't want to see the general partner taking these fees up front and then getting the portion of the profits on the back end. What if the deal doesn't perform as they initially promised? So what the general partner puts in, the ones that are they're investor friendly and investors, profit is very upfront for them. What they do is they put in a preferred return or a hurdle for their deals, where in most cases like an 8% hurdle. So the investor has to make 8% per year cumulative. Only after that, the general partner can take that portion of the upside. So the investor has to make 8% a year for the term of the project. If it's 5 years, if it's 10 years, any money that's left over in the profits, then the general partner can take his 30%, anything above and beyond that.
Okay. In 2 minutes, if you could, let's say, how do you manage downturn and manage risk in syndication?
Well, managing risk goes back to the fundamentals of real estate. Managing risk, I mean, as a sponsor, as a general partner, you're not dealing with investors. And investors, that means your name and reputation is on the line, and you want these investors to continue to invest with you. So you have to even be, and you're fiduciary to your investors. So you have to be even more careful when you're doing deals when you have investors compared to deals when you don't have any investors and it's your own deal. So you have to be extra careful. The way you can de-risk a deal, the most important thing, the Achilles heel of real estate is debt. So if you're putting the wrong debt on the deal, if the term is a very short term, if it's a high octane debt, if it's a variable debt, it increases the risk on a deal. If you're able to put long-term debt, if it's a fixed debt, if it's agency, or in Canada we call it CMHC loans, that brings the risk a bit lower on deals. And then having your team members understanding what the business model is, buying in markets that have continued growth and have the fundamentals that are needed for the projects to prevail. But the most important is always, paramount is always debt. And then after that is the market. And then lastly is the execution. So as long as you've got those three elements figured out, the risk should be less than more risky deals with high octane debt on them.
Okay. Where can people learn more about you and follow you?
I'm very active personally on LinkedIn. I'm a LinkedIn top voice. I create a lot of great content on LinkedIn, so definitely connect with me, August Biniaz, on LinkedIn. And then for our firm, CPI Capital, which does cross-border syndications for both multifamily and build to rent, which is a different asset class that we didn't speak about. But our website has a lot of great information. We have our underwriting model that you can download on our website. We have webinars that we host with expert guests talking about all different topics about taxation, about legal structuring, and you can access all of those recordings on our website. So a lot of great content and information on cpicapital.com.